Welcome back to the Summit View. I'm Matt McIntyre, and I serve as the CEO and founder of Peak American Investment Advisors. With me today is Scott Schwitzer, the head of our wealth management division, and we're going to talk to you a little bit today about how it's not your father's broker anymore. It's not your father's financial advisor anymore. Scott, let's talk about your philosophy on this. I've seen you do a lot of talks with a lot of packed houses with individuals one-on-one with people from all walks of life and talk to them about modern finance and how it's different and how it's changed just in the last couple of years. Go ahead and tell our audience a little bit about that.
Yeah, so I mean, if you look back at even the last couple decades, I mean, you go back to the early 2000s, we didn't even have iPhones at that point. Um, People use their advisor as access to information, access to investments. This was in the early days of the do-it-yourselfers. There wasn't many platforms out there, so people's only real option was to go to the broker down the street, the little office in the strip mall, and get some financial advice and buy some products from them. As time has evolved, though, we all have iPhones, we all have access to this information all the time now. And so the relationship has moved from a transactional basis to now more of a true advisory service where you're looking for someone to provide that guidance for you through life, not just, hey, pick this stock, sell this stock, but how do we plan for our future? So there's been a lot of changes.
You know, when you were speaking on that, I remember when I started making a little bit of money, I went directly. It was a national name brand. You'd recognize the name. And I went down and a friend told me, hey, go talk to my broker. And so I put $25,000 in this can't miss stock. I'll never forget Arrakis oil out of Canada. And it can't miss, all right. It was delisted in like 7 days after the $25,000. And I got a real education on the difference between a financial planner and a fiduciary, and really kind of what a broker or a salesperson was. Extrapolate on that. What is your philosophy on that? What is the difference?
So brokers are compensated by selling a product, whether it's a stock, an ETF, a mutual fund. They earn their living by sitting down with someone saying, you should buy, in your example, that what was it?
Arrakis oil.
Arrakis oil. Here's the reason that, we think it's going to do well. You'd give them $25,000. They'd probably earn a nice little commission off that. And then at some point down the road, you might choose to sell that. And then they would earn another commission. And they do that multiple times over with many clients. That's how they earn their living. Nothing wrong with that. That was what was available during the time. They weren't doing anything shady. That was just the business model at that point. But, to your specific situation, that advisor that was sitting there in that little strip mall probably had very limited access to information, to data, to aggregated data from the past, ways to sort through that. They're probably going off a tip that they read in an investment journal or maybe from a friend, and then they recommended it. You fast forward to now, when you come in and you sit down with an advisor, it shouldn't be product first, ever. If you ever sit down with any advisor and right off the bat they're pushing a product, you want to get up and walk out.
Yeah, let me ask you about that, because that was the next phase of what happened. And I'm in the business, right? And you were talking about this isn't your father's financial planner anymore. My dad was a great State Farm agent, one of the best I think in the history of State Farm, 43 years. And so he told me, hey, listen, you're doing great. You need to go over here, talk to this guy, and talk to my guy. And I walked in there, and then it was like, good night. I mean, if I could replay it, it was the dark wood paneling, and it was almost a condescending, fatherly approach. And they wouldn't tell you kind of what they were doing. It was just kind of all the Wizard of Oz. There was no interaction. Is that still going on?
Some places, yes. You want to look for, if you're going out right now and you're looking for an advisor, someone to help you or you and your family out, you want to work with a fiduciary. You want to work with someone that is legally obligated by law to do what's in your best interest, not just what is suitable for you. Brokers operate under the suitability standard, where there could be two identical products that they want to put into your portfolio that are going to help you. One could come with a 3% commission for the advisor. One could come with a 5%. That advisor can choose that 5% commission because it's suitable. It's not in your best interest, though. The best interest would be to choose the lower commission product. As fiduciaries, we don't sell products. We don't get compensated for selling products. We get compensated for providing advice and guidance. So we're going to put our clients exactly where they need to be, regardless of what the investment vehicle is.
Yeah, and I know I'm leading the witness here, so let's talk about it, because there's a brand out there that they are the 800-pound gorilla. They do a great job of marketing. They've done a great job. I think they manage over 200 billion. There are certain products they say never have, never, 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 and I always wonder, the guy building the house, I can't fix anything around the house, right? So I have to rely on professionals, plumbers, electricians. They never tell me I don't use a certain tool. They use every tool they can to get it done. Why would someone come and say, and let's just come out with it, say, never buy an annuity? I hear that all the time, never buy an annuity. Where I know is you believe in it, they have a place. So what is that philosophy? And I don't want to, disparage anyone. They're a great firm. They're outstanding. But what's your thought on that?
So firms that are solely driven on gathering assets know that when they put a client in a vehicle that, perhaps an annuity with say a 10-year period where the person that's owning that annuity is getting a good return on that money for 10 years, that money is dead to that advisor. They can't offer them another product. They can't earn advisory fees on it. So a lot of these big companies, they look at their bottom line. How can we consistently increase our bottom line? And having a product that you can't tie a commission to or you can't tie a fee to for a lot of these firms is a no-go. So they just say, nope, we don't sell annuities. Annuities are bad. Don't buy an annuity.
So what you're saying is, so a client comes in, they got $1 million, and maybe it would behoove them to have 50,000 or 100,000 of it in a annuity or like a bond alternative. They might not put it in there because they're not going to be able to generate fees off of it.
Correct.
Okay. All right. So let's talk about let's switch gears here for a second. So we've talked a little bit about not being your father's broker anymore, but there's another side that I'm seeing right now, and I know you're seeing it every day with clients that walk in here. I see everybody, maybe not your father's broker, but how about not your nephew who's in high school as broker? He's out there touting, I'm some of this crypto stuff, and I know we have a little bit of Bitcoin in our portfolio, but some of this stuff is like made up, and I'm trying to find out. So what's the danger in that?
So as we talked right when we started off, how the industry has shifted so much in the last 20, 30 years. We think about what is the primary driver of that. It's technology. Right now, where 20, 30 years ago, very few people had access to real-time market information. Most anybody who followed the markets 20, 30 years ago, they would get their updates from the newspaper that would tell them what happened the day before. Right? So now everybody has access to 24/7 information. There's journals you could subscribe to. There's online platforms you could subscribe to get really deep, insightful information. The problem with that is, I would say, people who do it for fun or on the week maybe spend, I don't know, 20 minutes a day or a couple hours a week researching one particular area of the market. Now take that information and say, well, hey, I could do this myself. Where it is a full-time job to manage a portfolio, to look over the markets. We have an in-house portfolio manager. His only job is to do research and look at the portfolio, look at markets. When everybody has access to information, you start getting this overconfidence. It's one of the big biases we see when we work with folks, because you've done some research. Maybe you made one I'll call it a risky bet. Maybe it worked out in your favor. Now you think that is repeatable because you're one little, victory there. It's not repeatable. You need to have someone that's in your corner, constantly looking at not just the area that you are focused on, but the entire broad market.
Yeah, you make a great point. I was watching one of your workshops. We were up at Stonebriar, great crowd, a lot of really knowledgeable people in there, people that have done really, really well.
Hmm.
And I watched when you were talking about behavioral finance and the mindset and the psychology behind it. I watched the whole crowd. They all leaned forward. They were listening. And I remember something, I don't want to put words in your mouth, but it was something like if you're out of the market on certain days, you miss the entire run up.
Yeah.
And I think the number one thing I learned from that day is, hey, I might know a little bit about how my car runs, but the master mechanic knows a lot more about it. I might know a little bit about this. So what is your mindset running portfolios and helping clients achieve their goals here at Peak? What does that mean when you're talking about the psychology of an investor and how you can help them protect themselves from themselves?
Yeah, and I think what you're talking about, there's a study by a company out there called Dalbar, and they study individual investor behavior. And what they look at is on a year by year basis, how does the individual investor do versus the overall market? Meaning, overall market, you have an S&P ETF and you just let it ride. You got ice water in your veins, and no matter what happens, you just keep going the course. And what they found was over a 20-year period, and they even did over a 30-year period, the average investor trails by almost half what the S&P does.
Well,
And so you look at a period of 20 years, I believe it was 2001 through the end of 2022. And uh, don't quote me on that. I think it was
sure.
general time frame. Uh, S&P, if you would have just left $1 million invested in the S&P, you'd have been left with a little over $6 million. The average investor, by missing just 10 of the best days during that 20-year period, turned their $1 million into about 2.2 million. So they left about $4 million on the table by just missing 10 of the best days. And what most people don't realize is when we have those markets and they go up and down, when everything's going up, nobody cares about anything.
Right.
The second it starts going down, that's where that fear, it's almost an ancestral instinct in us, right? We're protectors. When we see something going wrong, we want to protect ourselves. We want to protect our family. So we often think, well, I have to do something. I have to act. I should pull my money out of the market. And those timing errors, by missing just 10 of the best days, cost a significant amount. And one more thing I want to add to that. So when the markets go down, they just don't, chug along and then just fall off the face of the cliff, right? It's usually a slow, steady decline with a little steep drop at the bottom. The best days in the market, or about 70% of them, occur within 2 weeks of the bottom of the market. So while most people are out saying, I'm going to wait for things to get better, they're missing those best days.
Yeah, no, it's as someone who's actually made that mistake when I was a younger man, I feel that still even to this day.
Mm.
So you really got two ditches. I think you're trying to keep people out of. Is the one ditch is the do-it-yourself. Hey, I'm overconfident. I'm a genius because everybody's a genius when the market's going up, right?
Mm.
Um, you're trying to protect that person really from themselves because overconfidence, as we know, even Scripture talks about, God gives grace to the humble, but he opposes the proud. So a
Mhm.
lack of humility can cost people.
Oh, yeah.
So you have to manage that. And then the flip side of that, you have to manage the person who, they're listening to it and they're all gung ho and hey, we're going to invest in, bull sperm derivatives in China, and because I heard like me, Arrakis oil, I heard a hot tip,
Mhm.
and so you're trying to keep that. How do you do that? How do you do that as the head of wealth management? How does your portfolio manager do that? How do your advisors do that?
So we want to lead with education, right? We want to talk to folks and really understand how their mindset works with investing. And it's never a good idea to go head to head because there's a lot of very intelligent folks out there that we work with that could manage their own portfolio if they wanted to dedicate 10 hours a day,
Mm.
every single day to that. But most people in retirement, that's not what you want to do. So we want to lead with education. We want to bring these topics up to folks. That's why we do workshops a lot talking about the behavioral side of finance. A lot of people don't do that. More losses will occur from what happens in between your ears than from the market itself.
Mm.
And so almost protecting people from their own internal biases is one of the most important things an advisor can do. Your advisor should be a teammate, a coach, an advisor to help guide you along that path and be the voice of ration when things are getting choppy.
Yeah, so you want a rationally sane person when the world's going insane, right?
Hmm.
So that brings me to my last question. What is the difference today between an advisor in say 2026 today than what you've seen in an advisor even 5, 10, 15 years ago? What do you think makes a good modern advisor?
So you have to be adaptable, right? Technology is changing very quickly, and it doesn't make a good advisor great or a bad advisor good. But what it does is it allows a good advisor or a great advisor to spend more time on what's important to them and to their clients. And that's understanding their clients, that's putting strategies together to help minimize taxes in retirement, or help put strategies together to make sure their estate flows the way they want it upon passing. The technology is freeing up time. It's allowing us to do more of what
Mm,
is important to those folks. If you look back again, even 5, 10, 15 years ago, a lot of the technology wasn't available or is very expensive. Very few people have it. More and more good financial shops are starting to come together with these technology stacks to really be able to take a lot of the work that would have taken hours and hours and hours to put together, which is important for folks. We're able to now do that in a matter of minutes and spend more time on what's important, and that's helping problem solve for different situations that clients are going through, or help figure out how they're going to fund their daughter's wedding, or how they're going to help their kids with a down payment for a house, or how they're going to help grandkids' education. These are the important things that folks have worked their entire lives so that they can be able to do these things. It takes planning, and that takes time. That's where we want to spend our time. We want to spend our time planning and making sure that we're looking out for what ifs. And what if this happens? What if inflation rises? What if you don't get that promotion at work? What is savings? What happens to your savings? There's all these different external factors that take a lot of time in planning. The technology allows us to spend more time on those things, which is more important.
yeah, so what I'm hearing you saying is a great advisor really needs to listen, needs to do scenario watching because
Mhm.
things happen,
Yeah.
right? And anybody, gee whiz, I'll be 62 next month. A lot of life has happened in those 62 years,
Hmm.
right? Things where I thought we're going to go this way, they zigged and went the other way, zagged, and it's good to have a guide. So, what would you tell our audience? Because hey, we're out here, we are representing peak American investment advisors, right? We're not representing our neighbor's investment advisor. Why should someone come in here and really work with an advisor like Peak? What give us just one or two sentences of why should they work with us?
Well, I think the folks that come in see this firsthand, and I could say this to all the folks listening here today, is when you come in and you meet with us for the first time, we're not talking about products. We're not talking about how to invest your money. We're trying to understand you. And we want to know these clients intimately, where they are in life right now, where they want to go, the important milestones that they want to hit along the way. Then from there, then that's where we take everything and we put together a portfolio that's tailored to their situation, not someone that is in a similar situation, not all of our clients who are in a similar situation, but specifically to that client. Because you know you could be in a very similar situation as your brother, similar in age, right? But you could be completely different places in your
Mm.
life, and the strategy that we would put together for you versus your brother is going to be completely different. When you walk into an advisor's office, if they're not modeling out scenarios for you with financial planning tools, if they're not running risk analysis with financial planning tools, if they're not looking at how your estate is going to flow when you pass, if they're not looking at all these things and they're just offering you investment advice, go get a second opinion.
Scott, we've got it seems like we talk about keeping out of two ditches for clients, our clients. It seems like today you've got almost and I hate to use the word, my friends are going to yell at me for saying bifurcate, but I'm going to say it, where we've got robo advisors where, and I remember when the market took a hard hit, people couldn't, the technology shut down, they couldn't make trades on their
Oh,
website. It was just a mess, right? So you've got really, really high tech, and then you've got kind of the old school that not really, they don't really embrace technology, but they're high touch. It sounds like you want to combine both. It sounds like you're thinking, hey, we don't have to have either or, but we can have high tech and high touch. Can you talk about that?
Yeah, we can have both, and the technology allows us to even provide more of that high touch service to our clients by freeing up a lot of our time. We still want to be the ones, you're not going to call in and talk to a call center in Costa Rica. You're not going to talk to a robot on the phone. You're going to talk to a person. When you come in and meet with us, we're going to spend time planning your situation. The technology, the tools that allow us to operate in a much faster manner are just a complement to what we already do. We utilize the technology to free up our time to spend more time with clients.
So kind of a Cheers financial service where everybody knows your name, right? But you've got high tech on there, and you're
Mhm.
delivering the beer on high tech taps,
Yeah.
right?
And it's interesting too. I've been in this industry almost 20 years now. What the average client, when they come to us, they say, "Oh yeah, my advisor does all this planning already," or they use this software, and then we say, "Okay, well, bring in your financial plan. Let's review it." The technology that's being utilized by most firms out there is from the 90s, if we're being generous. It's very outdated. You want a firm that's utilizing modern technology, not because it's going to get you better returns, but it's going to allow your advisor to do a better job analyzing where you are now, where you want to go, and help identify those gaps and blind spots along the way where a regular person may overlook it.
Man, that's a great way to end today's topic. So high tech, high touch, not your father's brokerage anymore. Hey, thanks for joining us on this week's Summit View with Peak American Investment Advisors. I'm Matthew McIntyre with Scott Schwitzer, and we look forward to seeing you all again next week.